In this module, we'll look at HSAs and taxes. Pre-tax HSA contributions are obviously the most efficient way to contribute into an HSA. Pre-tax contributions can be made directly by the employer or by an employee via the employer's Section 125 cafeteria plan. Both the employer and the employee avoid payroll tax on pre-tax contributions. So this is a big deal for employers as well as employees, that they're able to save. In addition to the premium savings with that high deductible health plan, they're saving on payroll tax. So when we're really speaking about that payroll tax, at minimum, we're looking at the 7.65% for FICA, the Social Security portion being 6.2%, Medicare being 1.45%. Now, it is true that the Social Security portion of FICA is capped at a maximum income of $142,800 in 2021. But that Medicare tax, even for higher income earners, the Medicare tax of 1.45% is on all income without a cap, excuse me. So even if you have a situation with a higher income earner, there is still an advantage to them for these pre-tax HSA contributions in saving the additional Medicare portion of FICA. Post-tax contributions are also available with funds that's already earned and taxed. The only disadvantage of the post-tax contributions, you're not avoiding the payroll tax, but it is an above-the-line deduction coming off of one's individual adjusted gross income. So the individual still gets the tax benefit of the HSA as an above-the-line deduction on their tax return, however, whatever dollar amount they contributed. It's just they're not going to be able to avoid that payroll tax. Many times I think we as a firm focus too much at times on the long-term aspects of the HSA and the long-term benefits, and they're there and they're real. However, it's important to note the short-term advantages as well, those immediate tax savings from those HSA contributions, right? Even for those folks who may not be able to build up the balance over time. We look at that $7,200 maximum family contribution for 2021. Here we're just doing like a back of the envelope immediate savings. Federal tax at 24%. We in Rhode Island, we're using the 5.99% state tax, and then assuming that you've got the payroll tax of 7.65%, and again, that $551 is also going to benefit the employer. You're looking at total tax savings for the year on the $7,200 contribution of $2,710. So it's significant savings from taxes immediately by making that contribution into the HSA. When it comes to the tax reporting for a health savings account, if any activity occurred during the course of the calendar year, the tax year, the individual is required to include the 8889 form with their 1040. This is going to dictate what goes on that 1040 when it comes to the HSA. So any money going into the HSA, any money withdrawn from the HSA, if there was a failed testing period, if someone acquired interest due to being a beneficiary on an HSA, whatever that may be, they're required to complete the 8889. To assist with that, the individual will receive two forms, the IRS Form 5498 SA and 1099 SA. Now, the 1099 SA is regarding distributions, money that came out of the HSA. The individual will receive that, and the IRS will receive that from the provider no later than the end of January. Now, because you can make an HSA contribution right up to the tax filing deadline, the Form 5498 will not be received at the time in which someone's completing their tax return, because they can still contribute to that HSA. However, they'll be able to refer to their online dashboard, most likely with their HSA provider, to get that information, and they'd receive later on that 5498 as well as the IRS. So HSA and self-employed. So we're looking at self-employed individuals who are partners in an LLC or a partnership, and those who have a 2% or greater ownership of an S Corp. In all those cases, the individuals totally can take advantage of the tax benefit of the health savings account. However, they're not going to avoid payroll tax with that HSA. That's not available to them. However, the HSA contributions will be an above the line deduction from their adjusted gross income on their tax return. So again, totally can take advantage of the tax benefit of the HSA with the exception of avoiding payroll tax. If you still have questions with regards to this module, please email us at info@accesspointhsa.com.